In this video, I'm going to look at 20 essential slang terms that every beginner investor should know. And one of the things when you get into the world of investing, you're going to hear a lot of jargon. It might seem pretty overwhelming at first. I remember when I got in the business all those years ago, it certainly did. I don't want you to worry. If you truly understand the terms we're going to cover off in the video today, you're going to have a real edge. My goal, by the end of the video, you're going to feel more confident. You're going to feel ready to tackle this investment journey with that solid foundation. So let's get straight into it. The first term I'm going to look at is bear market. A bear market is when stocks are falling and you're going to see investor sentiment at a pretty pessimistic level. Generally speaking, when the markets have fallen 20%, it's considered to be in a bear market. That can happen fairly quickly. It can also happen over a period of months, typically 2 to 3 months is what you're going to see. Now, recognizing a bear market, it's important for a couple of reasons. One is because it can help you prepare for declines in the value of your portfolios. That's going to happen. You need to be mentally prepared for that. Also, it can help you avoid making some mistakes, which we're going to cover off here in just a second. It's kind of like when winter's coming, you might prepare your house. If an investment winter is coming, it's time to be cautious, possibly move some investments to some safer options if that's the way you manage your portfolio. Now, during bear markets, focusing on defensive stocks or reducing stock exposure can be beneficial. If you don't know what bear markets are, it can lead to some panic selling. You see the markets dropping, you might sell things at a loss, or worse yet, you might even hold declining investments. That can be a dangerous thing as well. Now, one of the most important things that you're going to need to know about bear markets, they're a natural part of the market cycle. Patience and strategy are key to getting through them. Second term is blue chip stocks. And these are shares of large, reputable, financially stable companies that have a history of reliable performance. So these stocks, they're important in a portfolio because they are considered to be the safer investments. They provide you with dependable returns. I think of blue chip stocks sort of like buying a well-known brand product. You know it's reliable. You know what you're getting. Same thing with blue chip stocks. I think it's important for new investors to consider starting a portfolio with blue chip stocks. That way you can build a stable foundation. You can add to the core around that. If you ignore blue chips in this phase, it could lead you to investing in riskier companies that are less stable, certainly can be more volatile in nature, which brings uncertainty to your portfolio. One of the most important things you need to know about blue chips, they offer stability, they offer reliability. It makes them, in many cases, the cornerstone of a long-term investment portfolio. Now, the third term, bull market. And this is the opposite of a bear market that we just talked about. A bull market is characterized typically by rising prices and optimistic investor sentiment. Expectations are that the market will continue to rise. Again, there is no 100% definition, but commonly 20% is accepted. When the markets are going up 20%, we're considered to be in a bull market. It's important that you understand what this is because it can be a good time to invest. Prices are generally on the rise. If you're not able to recognize when we're in a bull market, it could mean that you're missing out on some potential gains, some potential growth opportunities. One of the most important things you need to know about bull markets, they present opportunities for profit. They're exciting, but it's essential that you don't get carried away. You remain prudent and you don't become overconfident and take unnecessary risks. The fourth term, day trading. Day trading involves buying and selling stocks within the same day. Sometimes the holding period could be minutes, hours, but certainly within that same day. The goal here is to profit from very short-term price movements. It's really important for new investors to understand how day trading works because it carries a significant risk factor. It's generally not recommended for beginners. I think of day trading a little bit like gambling. I know some people will disagree with that. It can be sort of exciting, but it can be dangerous if you don't have the right experience and the right mindset. I think for most new investors, you should probably focus on longer term investing strategies. By far, one of the most important things you need to know as a day trader, as a beginner day trader, it requires extensive knowledge, discipline, very good risk management skills. So that makes it unsuitable for most new investors. If you do want to understand day trading better, check out a fellow Canadian, The Humble Trader, some great information for day traders. The next term, dividend. And dividends are the portion of a company's earnings that are paid out to shareholders. Typically, these go out quarterly. They could be monthly in some cases. In some cases, they're more ad hoc, even like once a year, a company may pay out a dividend. These can be important because they can provide you with a steady income stream from your investments. New investors often look for dividend-paying stocks to achieve a combination of income and growth potential. One of the most important things you need to know about dividends, they can provide that reliable source of income, especially during market downturns, and they do add stability to your investment portfolio. Next term, exchange traded funds or ETFs. An ETF is a type of investment that owns a basket of assets and trades on a stock exchange. So these can be important types of investment vehicles because they offer diversification. They have typically pretty low costs. They make it very easy for a beginner investor to diversify, to spread risk. I think of an ETF as a basket of fruits. So you're buying one basket, but it gives you a variety of investments in that one package. New investors, especially, you can use ETFs to diversify your portfolios without needing to buy individual stocks. Especially if you're starting with a smaller amount of money, this can be a great tool to use. If you're not aware of, or if you're not using ETFs, it can lead to a lack of diversification. It can put you at a higher risk profile than your investment strategy might otherwise be. One of the most important things that you should know about ETFs is that they provide a simple, a cost-effective way to achieve diversification that helps you manage and reduce your investment risk. Now, FOMO, the fear of missing out. This refers to the anxiety that you're missing a great investment opportunity, and it's very common. It's very important to recognize FOMO because it can lead to impulsive, very poor investment decisions. If you invest due to FOMO, it's like kind of rushing out to buy a popular toy or a video game. It hasn't been market tested yet. You might overpay or you might end up getting something of poor quality. It's really important for new investors to stick to your investment strategy. Avoid making decisions that are based on emotions. If you let this fear of missing out drive your investment decisions, that can result in buying high and selling low. Ultimately, of course, that's going to lead to losses. One of the most important things to know about FOMO is it can cloud your judgment. That's very common. It's critical that you stay disciplined and stick to your own investment plan. Number 8 on the list is index funds. An index fund is a type of mutual fund or ETF that we talked about earlier that aims to replicate the performance of a specific index. So you think S&P 500 or here in Canada, the TSX. And these funds can be important because they're used to get a broad market exposure, low operating expenses, and they typically have pretty low portfolio turnover. You can think of an index fund as a pre-packaged diversified investment that follows the market's overall performance. If you ignore index funds, you could be missing out on a simple, effective way to achieve diversification and steady market returns. One of the most important things that you should know about index funds is that they offer a passive investment strategy, and often the stats show will outperform actively managed funds over the long term. Now, the next term is IPO, or initial public offering. And an IPO, this happens when companies sell its shares to the public for the very first time. And they can be very exciting because they offer new investment opportunities, but they do come with their own risks. Investing in an IPO is kind of like buying a new gadget that's out in the market. It can be exciting, but also there's a lot of uncertainty that comes with it. On popular stocks, FOMO often comes into play here as well. Now, new investors, you should approach IPOs with a lot of caution. You need to conduct thorough research before you go and invest in one of these. Takes me back to when I was an advisor and when Canada Goose, the Canadian company, IPO'd. I actually was on vacation, but I got a call from a client. They said they wanted to get in on the action. They wanted me to buy shares of Mother Goose for their portfolio. Obviously, they hadn't done a ton of research on this. Now, one of the most important things you need to know about IPOs, they can be very exciting, but they're also very, very highly volatile. They're speculative. And if you jump into buying an IPO without the proper research, it can lead to buying very overhyped and potentially overvalued stocks. Now, the next term, 10th on the list here, is margin. And margin trading is when you borrow money from the broker to buy more stock that increases the potential returns, but also it comes with a commensurate amount of risk. It's important to understand because using margin can amplify both your gains and your losses. It's like taking a loan to bet more at a casino. You can end up with significant wins, or of course you can end up with huge losses if that's the case as well. Now, new investors, you should use margin very cautiously. I would say probably not at all, but if you don't fully understand the risks before you invest, using margin can be a very dangerous move. One of the most important things you need to know about margin is that while it can enhance your returns, it also significantly increases that risk that potentially leads to some large losses and debt. So that's 10 of these jargons in the books. I'm going to be right back with number 11 following this quick break.
Now, briefly, I want to say a quick thank you to today's sponsor, Faucet Mattress. As some of you guys may know, unfortunately, my daughter has eczema. It is so frustrating and annoying trying to figure out what it is that's flaring up her skin. Well, recently, we made the call to try switching up our mattress, and we opted for a mattress free of harsh chemicals, crafted on Vancouver Island, made from natural materials like Talalay latex and organic cotton. This mattress, of course, offers offers superb comfort and durability. You even get to pick and personalize your preferred firmness. I opted for the firm/extra firm option. That's just the way that we like it. I've said it before, but investing in your health to me is just a no-brainer, especially considering how much of our lives we spend sleeping. If you're like me and want to support a local homegrown company, you can use the code BEAVIS10 for 10% off the entire site. This is a site-wide 10% discount. Enjoy free shipping across Canada and a decade of guaranteed support. There'll be a link down below to check it out, but make the switch to a healthier sleep today with Faucet. Thank you for sponsoring the video.
Okay, number 11 on our list is market cap or market capitalization. And this is the total value of all of a company's shares. And it's an important metric because you use it for comparing size and often with that, the stability of a company. If you can picture an orchard with a certain number of apple trees, each tree produces a certain number of apples. So the total value of that orchard can be calculated by multiplying the value of one apple tree by the total number of trees in the orchard. It works the same way. New investors, you can use market cap to diversify your investments across small, mid, large cap stocks. Having a portfolio of all one or the other probably isn't the best idea. If you ignore market cap, it can lead to an unbalanced portfolio, often with inappropriate risk levels. One of the most important things that you need to know about market cap, it helps you assess a company's size, stability, and growth potential. Now, the 12th term is a mutual fund, and a mutual fund is an investment vehicle that pools money from many investors to purchase a diversified set of securities, very similar in operation to exchange traded funds, ETFs. So mutual funds, like ETFs, they offer professional management, they have diversification. You can think of it just like an ETF, that basket of fruits. If you buy one basket, it gives you a variety of investments in one package. One of the most important things that you need to know about mutual funds is they offer an easy way to gain access to a diversified, professionally managed portfolio, but they do often come with some pretty hefty management fees. They're not as popular today as they were years ago because of the market competitiveness out there, but that's what a mutual fund can offer for you. 13 on the list, the price to earnings ratio, the PE ratio. And this is a measure of the company's current share price relative to its per share earnings. This is an important metric, and you're going to hear this all the time because it helps you evaluate whether a stock is overvalued or undervalued potentially. If you have a high PE ratio, it might indicate that a stock is overpriced. It's kind of like paying too much for a trendy item or perhaps a Taylor Swift concert. I'm not sure how that would go. I know I'm not going to one of the concerts, and maybe you are. If you're a new investor, you should use the PE ratio to learn how to compare stocks, find good value investments. If you ignore PE ratios when you're making your investment decisions, it can easily lead to buying overvalued stocks or perhaps missing out on better opportunities. One of the most important things you need to know about the PE ratio, it provides a quick snapshot of a company's valuation. It can help you identify potentially overvalued or undervalued stocks, but it can't be used in isolation. It has to be used as part of a bigger evaluation. 14 on the list, penny stocks. So these are very cheap stocks, typically costing less than $5, but often literally pennies, 10, 20, 30, 40, 50 cents per share. It's important to understand what penny stocks are because they can be very volatile and risky. Typically they are. You might be lured into buying a low price stock because you can get more shares for a smaller dollar amount. That's particularly pertinent to newer investors. I look at investing in penny stocks kind of like betting on an underdog. They have the potential for big wins or losses, but losses is a key there. If you are a new investor, I would suggest that you be very, very cautious. If you're thinking about buying penny stocks, only invest a very small portion of your overall capital. One of the most important things you should know there, penny stocks, that while they do offer that allure of higher returns, they do come with high risk, typically low liquidity, and it's not unheard of that they are a large potential for fraud as well. Number 15, a portfolio. This is one of the basic terms. You're going to learn this early. Hopefully you're starting to construct your own portfolio now. And a portfolio consists of all the different investments that you own. Now, building a proper portfolio is kind of like creating a balanced diet. A variety ensures better overall health. You don't need all the one thing. You don't have a portfolio that has everything that looks the same as well. New investors, I would suggest that you think about building your portfolio spread across different investments, different sectors, different asset types, and that will help you achieve diversification. If you have an undiversified portfolio, it certainly increases the risk of significant losses if one or more of those investments performs poorly. One of the most important things that you need to know about a portfolio is that diversification is the key to managing risk, ensuring more stable returns over time. Term number 16 today, pump and dump. And a pump and dump scheme artificially inflates a stock's price through false, misleading statements, and then they often sell off at overvalued shares. Recognizing scams like this is important to help you avoid significant losses. Pump and dump schemes, they are like counterfeit products to me. They look good, they're presented really nicely, but they end up being worthless. New investors, particularly, you should be skeptical of things that are too good to be true. Some stock tips that you're getting. Falling for pump and dump schemes can result in buying worthless stocks, losing a lot of money. One of the most important things you need to know about this pump and dump scheme type thing is that they are illegal, they're unethical, and if you recognize the signs, it can certainly help you avoid any big financial losses. Now, number 17 on the list is sector. You will hear this term quite a bit as you're going through your investment journey. It's basically a group of stocks from the same part of the economy, like technology or healthcare. There are 11 main top-down sectors in both Canada and the US. Now, investing across different sectors helps diversify, helps reduce risk. I think of investing in various sectors like eating different food groups for a balanced diet. It's a similar concept when you're building your portfolio. New investors, I think that you should include stocks from multiple sectors that help spread the risk in your portfolio. If you focus too much on one sector, it can lead to high risk if that sector underperforms. One of the most important things that you need to know about sectors is that diversification across different sectors helps mitigate risk. It helps you capitalize on various economic trends. Number 18, short selling. Now, short selling involves borrowing shares with the intention of buying them back at a lower price. You're going to hear this term, but it's really important to understand it involves a high level of risk and huge potential losses. It's kind of like betting against a sports team. If they end up winning, then you end up losing. One of the most important things that you need to know about short selling is that it can result in significant losses. In fact, the losses are theoretically unlimited if the stock price rises. If you are new, you're going to hear about it, but don't go there. Now, 19, next term on the list is volatility. And this refers to how much and how quickly a stock's price moves up and down. High volatility generally means higher risk, higher potential rewards. I think of volatility like a roller coaster ride. It can be exciting, but it certainly isn't for everyone. New investors, you have to be aware of volatility, be cognizant of it, be prepared for these huge price swings. If you're invested in a sector that experiences high volatility, you can adjust your investments that are based on your risk tolerance so that the ride you're going on is not too up and down for your liking. If you don't account for volatility, it can lead to panic. If you see huge market swings, it can result in investors selling out of investments that they should probably be otherwise holding. One of the most important things about volatility, while it can offer these opportunities for profit, it also increases the risk of rapid and substantial losses. Now, the last item on the list, yield. And this is a measure of earnings that are generated from an investment relative to its price. It is important to know this because it indicates the potential income that you can expect from your investment. It's kind of like a farmer growing crops, and the yield is the amount of produce that's harvested per unit of land. For example, if a farmer grows wheat, the yield might be measured in bushels per acre, similar with your stock market yield here. Now, new investors, they often look for investments with good yields that provide steady income. This is especially important if you're an older investor and if you're looking for cash flow into the portfolio. If you don't pay attention to yield, it can lead to missing out on potential income from your investments. One of the most important things that you do need to know about yield, it provides insights into the income generating potential of an investment, and it makes it an important factor in selecting income producing assets. I was a beginner once. I made tons of mistakes. This video here will show you 26 rookie mistakes that you're going to want to avoid. Thanks for watching. We'll see you in the next video.